Welcome back to Romberg and the Money, your weekly rambling stock market rundown where we, your hapless hosts, discuss current events and spread wild conjecture in an ever-shifting market. We are rank amateurs. Every word we say is the opposite of financial advice and should be completely disregarded. Romberg is not for everyone. Please consult with your financial advisor to see if you are healthy enough for Romberg.
So we're here, but I'm waiting for the disclaimer. That's your role.
Oh no, see, the disclaimer already happens. I edit that in.
Well, good afternoon.
Good afternoon. It is Friday, June 25th. Pretty. What's how was your week?
Wait, June 25th, what year? I'm really old. I don't remember dates. 2021.
Unfortunately, it is still 2021, the year that just will not end.
So, Alzheimer's for me, I'm always waiting for it and wondering when it's coming. So you can always remind me to make sure that I'm investing in the stock market or speculating in it in the right year.
If you're using 2020 numbers, you're going to be a little behind the curve. That's all I'm saying.
Okay. Well, actually, I might have done better in some periods of time along there. So anyway, what's been going on? I'll tell you, but this has been a weird week, right?
It has been a weird week.
It's I love all the soothsayers in the marketplace out there that are always going, oh, let's you need to move your money from tech to financials, and then wait a minute, now you need to move them to retail or something that is currently moving upward because of Christmas or whatever coming, something like that. And they're always telling you where to move your money. I always wonder, how many of us out there think, ooh, we need to do this. We need to do this. We need to go to consumer cyclicals, or we need to go to, banks, or we need to, because they say so. What a bad idea that is. That's just such a bad idea.
Well, I mean, it works out great for them.
Well, it works out great for the people selling you the stuff.
Exactly. They're selling the stock, and they're saying, hey, you should buy this while they're selling it, and then, that keeps the price up while they're selling, and it works exactly as intended. Let's put it that way.
There's always a winner, isn't there?
Yeah.
Our goal here at Romberg is to let you be the winner, right, instead of them. So
our goal here is to keep you from being the loser as often as possible.
Yes, and that's why you should never listen to us, because we do not know the future.
No.
And our advice is probably really bad.
Our advice is terrible. Terrible and worse than meaningless.
Right. So I'm sitting here looking at the week, and I'm thinking, okay, so what happened this week? So
what did happen this week? Talk about major headlines here.
So financials dropped like a rock for a little bit, right?
Uh-huh.
And it's like because the yield curve issue, right? And inflation and the Fed not acting, not enough acting, talking about things that haven't even happened and just maybe might happen. If too many people, I can tell you that Bernanke poops on the toilet like the rest of us. I'm just saying, he does. By the way,
still relevant?
Well, it is kind of relevant because.
No, Bernanke. I thought he hasn't been there since 2014.
What are you talking about? Oh, Powell. Jesus. I should not go to the bar before we do this.
Yeah, I mean, yeah. Actively drinking.
I'm at Powell. Fed Chair Powell. So thank you for correcting me. This is why you shouldn't listen to me, because I don't even know what year we're in. I told you that earlier.
President Bush made a statement earlier.
Anyway, so, we got mixed messages, and then everything drops out, right? Well, there's no mechanical reason for it to dump, right? So the weird thing was, so why did it come back? Why is it on the move again? Well, unemployment numbers again came back, and they're like, well, they aren't as bad. They're stable. Things didn't wildly move in one direction or another. So all of a sudden, magically, we're happy again. They like to play on our emotions way too much, and we are willing to let them do it. And so I'm going to encourage all us crazy speculators and investors to have our own plan. Have your own plan and have the conviction of your plan to not let them sway you from it. It's a long game. It's always a long game. You always see me out here with these 5-year charts first, and it's because it's a long game. I might be playing in the short window. I might be up here, playing up here in this circle up here, but the game is the long game. And I always want it to be working in my favor. And the plan, everyone should plan that way, even in speculation. So that's kind of the news. Everybody's being told that growth maybe should step away from it. And then, because inflation might erode some of it. And then, I go back to the issue, not the issue, but the basic facts that these gigantic tech companies have all the money. And if I'm putting my money in a bank, like an investment, I want my bank to have lots of money. So when I come back to get it out, it's there still. So I can tell you that most of the time stock pickers, they'll talk about the stock pickers market. I think I heard that recently. How about you?
Stock pickers market? No, I'm not familiar with the term.
Well, it's kind of like, the indexes went way up. Can't play the indexes. Sectors went way up. Can't play the sectors. But inside of the sectors, inside of the indexes, are these little tiny pieces of you can go and pick and choose through the stocks, right? So I want to be in tech, but I probably shouldn't own Amazon. Well, that's crazy. So I should go pick a stock in tech that no one's ever heard of, that's on some growth curve that might make me some money. I mean, that's kind of like where they go with that idea. And I don't, and all I can say is with a small portfolio, and I don't know what anyone's portfolios are, but I wouldn't pick stocks individually if I had less than $5 million. It's just a bad plan, because one of those companies can hurt you so badly, and people get lost sometimes. And this is going to the moon, which would be a fun trip. Like Bezos he's going to get close to the moon, closer than I am. Bezos. And so, but it goes.
Quick detour for a moment here. Have you seen? Yeah. I assume you've seen the thing about the signatures to keep Jeffrey Bezos from being allowed back into Earth's atmosphere.
Okay, not really, but I get it.
No, there's a petition to deny him re-entry.
Well, we don't want him in space all the time because his brain is so large. He'll look down on all of us, and he will have us all in his sights. In fact, he can rule from space, because that's the ultimate throne.
I think that's his plan, honestly. All these people are like, oh yeah, we're going to make it so he has to stay up there. Like, what makes you think he wants to come back?
Yeah, exactly. Well, Elon's going to be really disturbed by this whole thing. It's like, well, wait a minute. I thought I was the king of space.
Exactly. He spent all this money making himself king of space, and someone else is going to get to live there first.
It's just it's going to be fun to watch. Let me put it that way. Oh. Yeah. But, so we should always have a plan. I barked on that for a couple of times. So here's a plan. I got an idea.
Here's your plan. I'm listening.
All right. So I'm going to go really kind of narrow on a couple of things here, because we've talked pretty broadly about stuff like this.
Sure.
So what would happen if I went to there's the monitor, right? And it's I don't have. There's some holdings in here from something I was messing with a long time ago, and this is unimportant.
Okay.
So I'm going to get rid of it, and boom, it's gone. So what if we decided, let's take the TQQs. Here is a strategy. I'm not advocating it, but I will. I'll show you how a plan could work. Somebody who's thoughtful about what they want to do.
Okay.
Let's say, now, this is options, not stocks. You can lose all your money in options.
Yes.
But it also can limit your risk. So let's say I want to own the TQQs, but I don't own them yet.
Uh-huh.
Let's say that I have enough money to pay the current price of $117 a share, and I have enough money to buy 100 shares, which would be the equivalence of a contract. So $117 would be $11,751 of a purchase.
Uh-huh.
All right, because I like that. So now I've looked at the chart on the TQQs. I've looked and I see the channels over the 5-year window, and I see that there's a marker up here, and we'll zoom in on this, and I see that we're at the top of this channel line, a little bit over bought. And but it also has made a move from baselining, which was in here, and it broke out and reached its high. So I'm looking at this and I'm thinking, well, where would I want to own the stock? Because I'm going to buy it. Okay, I'm going to buy it. So where would I prefer to own the stock at? So maybe I would prefer to own it at the lower part of the channel at $101.
I mean, generally speaking, yes, you would prefer to buy it low.
Okay, great. Buy low, sell high.
Buy high, sell low. Wrong.
I could just go buy it right now and pay the $11,700 for my 100 shares, or I can come back over here and say, well, if I can go out to January, which is
buy deep in the money, long call or long.
No, I can be a seller, which makes me. Yes, exactly. So I could go in here and say, I want to sell the put. I don't want to buy it, because that'd be making the wrong bet. It would run against the trend. I'm going to make. This is a very simple. Options are really complicated and can be really complicated, and if you overcomplicate them, you can get yourself in trouble. But let's just take a simple premise. I want to buy the stock today, but I don't want to pay $117. So I can sell this put to somebody else who's going to have the right to sell me their TQQs at $117 in January of 2022 for $117.
Right, but until then, you get to keep the premium.
So I'm going to sell that one single. It ended up being a purchase. I'm going to sell one contract, get down to one contract, and I'm going to sell it for $18.75. So I don't have to bid that. I can bid somewhere in between. I can go in the middle and hope to get an execution. But what does it mean? Let's look. I open up and every program is a little different. Of course, I'm still using, the program that needs to sponsor me. Strike that from the entire dialogue when you do your edit.
I will not. I'm going to leave that there as is.
So what is this telling me? Okay, I'm selling 100 shares, a contract, one contract, equaling 100 shares. Somebody is going to give me $1,970. They're going to give that to me.
Yes.
That's going to go into my account, and it's going to sit there.
In all likelihood, you're probably going to use it, but yeah.
I'm going to be obligated to that $1,970. So it's going to be debited. The entire purchase of $11,000. Well, actually, the debit value is $97.80 because I'm getting $19.70. So in the end, my break-even price on this is going to end up being basically 117 minus $18 because someone gave me, or 19. So someone gave me that $19. So in January 22nd, or in January, whatever the date is on this particular one, January 21st, 2022, if the stock is anywhere between 117 and $98 roughly, I'll have made money. Whatever the value is in between there.
Right.
If the stock goes down to 115, guess what I did? I bought it at 117.50. And so what? Because in the end, I was going to buy it anyway. It's
right.
Just now I've bought it down here.
Yep.
On the long channel. I'm in a better position longer term for gains. It could continue down and I could lose more.
I think one of the really only downsides of this kind of strategy is it requires you to have, the cash to sell the put up front.
Well, so you're stuck anyway. If you're going to trade the stock, and by trade I don't mean day trade. I mean you're trading it. Maybe this week you trade it. Maybe a month from now you trade it again. If you're doing that kind of trading, if you have less than 100 shares of anything, then you're not going to trade profitably anyway, unless you pick the random one stock out of thousands that happen to just randomly ride the rails up for some unknown reason. Or for good reason, for all that matter. It doesn't matter. When you're trying to pick something that goes to the moon, or pick something that's going to move 10 points, let's say you bought a stock, any stock at $10, and you bought 50 shares because you don't have enough for a contract.
Mm-hmm.
Well, 50 times 10 is $5,000. If it goes up 50%, what are you going to make?
You lost me at the math, honestly.
Oh, well, the point is you have to pick the right stock, and it has to move up 50% so you can make $2,500.
Right.
Right. But the likelihood is it'll go up 10%. All right. So I got $5,000.
What you're talking about here is leverage.
Yeah, there's no leverage on it at all. So you're netting it out and hoping you pick the right stock.
Right.
Which is a poor plan. So let's take a different stock here. Let's take, here's another one that is got some volatility, for instance. And, you can see the chart's kind of similar to the TQQs. This one trades at $52, right? Same scenario. What can I do? I can go out here. And the reason I picked these longer windows is like in before, where we were $118, and we're getting or 117, and we're getting $18. Well, what is that? That's like 10%, right?
Right. Yeah.
Roughly. And you're getting
another benefit of picking these longer time scales is you're less vulnerable to short-term changes in price.
And as the time erodes away, you're making money. So, for instance, today, but anyway, look, I'll just show you on this one real quick. So here's the at the money value. So that's like 12%, right there.
Yeah.
So if I go out there and this stock on the long trend, if it's the trend is my friend, is still going up, up, up in the long run. So that's 12%, and I'm making it in 6 months. I'm making 2% a month. Anybody in their right mind would take that deal if they're going to make
2% a month. Sign me up.
Yeah, exactly. Now it may not work out that way because it doesn't always work out exactly that way, right? But because it might end up being $52, right, instead of $51.81. Well, it won't matter. You still made most of that money anyway. It would have to be way down here somewhere. Well, it'd have to be $46 roughly for that to become a bad deal. And it's not even a bad deal because you could have bought it. You would have bought it at a higher number anyway. So why buy at the highest number when you can buy at a preferable number? There's always a downside, right? The downside is this stock goes from 50 to 60 in a month instead, right? 50 to 60. I make 20% in 30 days instead of 12% in 6 months. All right. Well,
I'm waiting for the downside.
Okay. Well, so it's a balance of whether or not I get to make a lot more faster, or whether I make my money on a more stable, less risky.
Right. And we were talking about this a little, like a couple months ago. Was I had sold some options, and then I had gotten more than half of their total in maybe 10% of their contract duration. It's like, well, I guess I closed them out.
So, right. Well, and the other thing is you can close these positions anytime you want, right?
Right, exactly.
So
that's what I was thinking. I'm like, well, like this, when I was talking about making, X in 6 months, that was a good deal. But now I'm talking about making less than half of that in 5 months. It's like, well, why?
So if somebody did give me $850 for this, let's say, this contract of 100 shares, they gave me the $850 and it went up 20 points. Well, the time value erosion is going to rapidly diminish quickly. You can literally close that $800 deal out in 30 days, maybe, and make 400 of it.
Yeah, I was say walk away with half of it.
Yeah, exactly. And another, I'm not going to show you, but like today, if you looked at the TQQ values, this
is something that I struggle with almost every time, though, is because, the reason that you've made all that money, like you've, quote unquote, made it, the value has dropped so much, is because the odds of the stock going back down to that price are now significantly lower, right?
Right. As they go up, if you're selling a put as the stock value goes up,
right,
the time erodes the value away on what is the option.
Well, the time and the current value of the price versus the strike price. Yeah. So, you look at it like, oh, well, I'm gonna make only half of this total amount in the remaining, majority of this time scale. But the reason behind that is that it's much more likely to happen. You're much more likely to get to pocket that, $400 in its entirety if you just wait the extra 4 or 5 months.
Well, yeah. So I was just trying to show the basic premise of the idea of trying to buy low and sell high. But so I oftentimes will leave a trade with money on the table. So in the case of selling this put on the TQQs for $18 for 6 months, if I'm in 4 months of the 6 and only 10% of the time value is left, I'll leave, because I can reestablish a new position at a higher rate and
Right,
get
at
a higher
a further time.
right,
Yeah.
and a higher compounding value, and take that money off the table and get a bigger return. So like a great, kind of interestingly today, which I like to once in a while, I look at these and I go, wow, that's pretty good. So today you can see the TQQs kind of started up and then went down and closed a little lower than yesterday's close, right? Not much, but a little, down 0.37% or 0.31%, 37 cents. Guess what? I made money on those today. My TQQ holdings in my personal account value actually went up.
Yeah.
And it went up because of the time erosion on those options as time marches on. The value of the TQQs went down less than the time erosion value, so consequently I ended up with a gain anyway on this stock today. So these are kind of complicated, can be complicated, but they don't need to be. You just have to understand some very, very basic things. So if we were talking about options on call, just call and puts, not talking about condors, not talking about strangles, not talking about collars,
Yeah.
just calls and puts.
No spreads.
No spreads.
Just single options on single stocks.
Right. So I could go out and say, again, back on these TQQs again, what if I wanted to buy? So to buy an option is a bullish bet. You're already betting that it's heading up, right? I'm not going to go out to January. Oh, well, I could start here really quickly and say, so the options part of the market, there's a little discrepancy here, but the options market, it's not very big. The options market says I'm betting $20 today that this stock is going to be higher than the current value, 117.50 plus $20. So if you bought this for January, you're betting that it's going to be above $138.
Mm-hmm.
All right, and that would cost you $2,000 for that contract. Now, I wouldn't do that because I'd rather make my bullish bet this way by selling than by buying.
Right.
It's a preference.
Yeah, because when you're buying, the risk there is you're playing against time erosion.
Well, in both cases, time's going to kill me off one way or the other. But on this side of the equation, I'm spending my money for the bullish position. On this side of the equation, on the put side, I'm being paid money for my bullish intentions. So if I sell this, it's bullish. If I buy this, it's bullish. It's just, do I want a debit transaction or credit transaction?
Right.
Right. So, but to go back to some other more basic underlying concepts, if I drill back up and I go June 25, which is, next Friday, I guess. No, that's today. So, July. If I go out there and say, I think it's going up next week by, we're at 117.50. I don't know, we pick 117.50. We're at 117.50. So another way to play it, if you really believe that TQQs, if you're following the chart and you've got some sort of strategy, are going back up next week, you could buy 100 shares for $2.60. If you buy at the market, $2.63. So for $2,630, you can buy an option that says by next Friday this will be higher than 117.50. Now, this would be a bullish move to do this right here. But the bullish move and the risk in the bullish move is that if it doesn't make it to um, uh, that's a 117.50. So that if it stays above 117.50, essentially, you're going, actually it has to be 117.50 plus 263. You're not making money until it hits like 119.
Right.
But if it goes to 130 next week, of course, you're making bank, and you spent a fraction of the money because you leveraged it pretty big.
That's the advantage, and that's the risk.
Right.
The risk reward right there.
Yeah. Well, and the risk is defined. This is the bigger issue is when you buy it that way, the risk is now defined. The most you're going to lose is $2,630 on the contract.
Yeah, that's true. Yeah, I struggle with that a little bit because it's a total loss, and if you're playing with numbers big enough to be relevant to your account, that's bad.
Well, there's the other way is to go deeper into the money, but that means you plan to buy it anyway. You're going to buy it, so you could go down to 110. Of course, that would be 118.30 on your break even. You could go deeper and go down to 100, let's say, at 18. That's 118.05. So that's your new break even. I mean, you can get some leverage on the long side by buying an option call, but I'm not an advocator of short-term call options unless you're ready to literally just buy the stock. And if you're going to buy it,
to buy the stock, that's
I would rather buy it on the other side of the equation.
I'm trying to think of what this is called, where you buy a long-term, deep in the money call, and then you, I think, sell out of the money calls on it. It's called like a poor man's something or other.
Yeah, I mean, so that's why I didn't want to drill into all that kind of detail because there's all kinds of ways to mitigate your risk. I'm just pointing out that I wanted that there's a couple of basic ways to do this. You can also sell a call if you have the stock. Right, I wouldn't advocate that at all, because now if you own the stock and you're selling a call against it, you're actually betting against yourself. Now, you could go way out of the money and say, well, I don't believe the stock will make it to this number out here at 121, for instance, so I'll sell that call. Right. And I'll get $112. But you have to know what the volatility of your stock is. This particular stock could move 10 points in 2 days. Right. That'd be a very bad bet.
All right. See, this is a place where I think you and I disagree a little bit. Is when I'm looking at this, I'm saying, okay, well, I own the stock. If I'm selling an out of the money call on it, right? I'm saying, if it goes up 20% in the next 6 months, like I'm happy to cash out then, because what my concern is then is I put it at a number where I start thinking the stock is overbought. So I think of it as like a way for me to back out of a stock that has maybe overheated and get that premium in the meantime.
So fundamentally, there's 2 questions a person should always ask themselves. 1, do I want to be in the stock? Because if you do, you're betting against yourself by capping it with a call option. Sure. If you don't want to be in the stock because you think it's overbought, then just sell the stock.
Well, that's what I'm saying. I might not think it's overbought yet, but if it goes up, 20, 40%, whatever I sell my call at, that would change the math maybe.
The problem is that you don't know how overbought anything's going to be. No, it can be overbought for a very long time. It could be overbought for 3 months and continue getting overbought, more overbought, and more overbought. In the meantime, you're losing out because you capped yourself at a value. It's just a bad strategy, at least from my perspective. It's a bad strategy to sell options against stocks that are climbing. If they're not climbing, you shouldn't own them. If they're not trending up, you shouldn't own them. And if you're trying to sell at the higher part of the overbought, then you're trying to time the market. Market timing is another bad strategy.
Yeah.
That's why the indexes outperform money managers 90% of the time. You can't time the market. But what you can do is mitigate risk. That's the dominant game. Mitigate the risk. Don't mitigate the opportunity. Mitigate the risk. That's what I say. Anyway, I'm crazy and I should never be listened to.
No,
And this
it's a
may
totally
seem
like I think that's a totally valid take on it. You know, you're
this may
saying
be
you want to get everything you can out of it.
yeah. Well, I don't know. We're probably just you and me are probably the only two people that listen to our own stuff here, but
Well, it's
I,
probably for the best if we're honest.
honestly, it probably is because I am the most confusing person I've ever listened to. Sometimes I ask myself, what did I say? I don't even understand it. That's just crazy. Hey, will you fly over to Hawaii and drive me down to the old folks home?
Um, do I get your portfolio?
No.
Then probably not.
All right. Well, all right. So what's on your mind anyway? I mean, I blab. That's me. I just blab. I had a good week, and I'm very happy with what went on this week. It worked out really quite well.
I had a pretty good week, honestly.
Good.
Nothing terribly exciting. I've been long on Iron Mountain. It was up, 15% or something. Now it's up, 9%. It's had kind of a bit of a slide recently. My intention is to hold this stock for a while. It's IRM if you're curious.
Well,
Um,
I didn't want to make an example of you.
oh no, I know you're going to. We've talked about before how you're not a huge fan of Iron Mountain. Um,
Uh, I'm not a. Let me just correct you about one thing. I could really care less about any stock.
right.
I just don't care. I only care. I'm like Mr. Wonderful on the Shark Tank. I only care about making money. The rest of it is only the vehicle I can find to do it with. I
Right.
have no dog in any fight other
Yep.
than how do I make money with this particular. Um, what was the symbol?
IRM
Oh,
is in,
M.
yeah.
Sorry. Well, you know what? The
That's just
short-term
M.
window is
That's
pretty
just
gosh.
M. That's just M.
Oh, well, stupid. Well, all right. Still not so bad.
No,
So,
I'm still happy with it. Like I said, it had a rough week. It hit the top of its channel, and now
yeah,
it's hit kind of the bottom of its channel.
yeah. Where's your exit? Do you have an
So,
exit?
that's a great question, Jim.
What's the most amount of money you're willing to lose on this before you decide it's probably not for you to be there
Here's
anymore?
where I'm at, without giving away my hand entirely. Basically, my thought is, as long as it stays above the price I bought it at, I'm a happy camper because I've already gotten a couple of dividends from it that have been, substantial enough. Um,
So
so
basically, your baseline cost.
yeah,
Well, I mean, that's a plan, right? At least
yeah,
it's a plan.
yeah, and
Um,
I'm mitigating that a bit because when it hit the top of the channel, I actually timed it fairly well. Going back to what I was talking about, like when you sell calls, I sold
mhm.
some calls on it when it looked like it was getting a little hot and there was concerns about it dropping off. I'd seen a couple articles and I was thinking, okay, well, like there was a very interesting article that came out that was talking about insider sentiment, like what are the people that work at this company doing? And there was signs that they had been selling. So I was like, oh well, I don't really want to get rid of the stock long term, but I am going to go ahead and sell some calls on it and at least kind of reduce the amount of money I'm going to lose on this drop so I can use it elsewhere.
I'm glad that we're talking about one of the ones you like, because normally all we talk about are the things I'm trading. So anyway, so this I like to look at things that
What is this? This is 3 year,
this is two.
2 year. Okay.
Yeah. So I like my drawing tools. You know me.
Yep.
So this whole chunk through here,
Yep.
obviously a side channel. This whole chunk through here, obviously COVID.
I was gonna say that. I think that's COVID.
And then, of course, I like to look at what this really
There was
means.
this silly little cold virus that ruined the world. Did you remember that?
Uh, I just like to get rid, I mean, I'd like to get rid of this kind of a noise.
Exactly. It's hard to work with, honestly, when I'm looking at these charts.
Yeah, and if I was to, I mean, in this window, you can see that the mean average um, is actually 34.55. That's the mean
Yeah.
on this pile. But if I'm looking at it, if I get rid of the COVID and I get back to maybe a more reasonable, where would this have wandered to with this pattern? It would probably have been somewhere up about in here somewhere. Come
Yeah,
on,
like I think
about
if you
there.
look at it, there's basically this valley almost from the peak on the left right before COVID, because it was clearly on an upward trend in the like month up to COVID. And
Yeah,
then you can kind of trace that across all the way, and you can see where
yeah,
it kind of climbed its way back out of COVID. I think that was in January of this year.
yeah. So, so I just drew two lines. One is a mean average that incorporates this value up here,
Hmm.
and which is this line here. In fact, I'll just get rid of this other line. I like to do a little bit of deconstruction and not a judgment on the on what you're doing, of course. Not. I'm telling you, it's not. So let's get rid of this one. So this is a regressive average line that incorporates this upper value and then all these other values in between the upper value. Or the other, so if I follow this line, we're talking about $39. I mean, you get into overbought up above there from my perspective. That does not mean it will not continue up there because these lines can drift upward as they,
Yeah,
if they
it
can
depends on what
maintain.
timeline you're looking at, because you're looking at a
Right.
company that is growing. They've changed their strategy. Like I said, you talked about like kind of knowing what the story is behind a company and using that to base your decisions. What I'm looking at is they have a solid business of where they're maintaining all these paper records, right? And
Yep.
unfortunately for a lot of these companies, they're kind of held ransom.
Mm-hmm.
But at the same time, they're transitioning very aggressively into like a cloud data management company, and they've got the wherewithal to make that happen. And I
Yep.
think what we saw here in this 15% run up that happened very quickly is the kind of the exuberance phase, and now we're seeing like the valley of disappointment. And so if we follow that kind of trajectory, I do think we're kind of going to be looking at like a return to like
Yeah.
$39, which I
So,
wouldn't be thrilled about, but I could still stomach.
well, so I'm not saying it would go there because we got a situation, that this is why why you always need to know what kind of trader you're going to be, right?
Mm,
Because I have a very rigid strategy. I have a very limited pool of stocks that fit the strategy that I've worked on developing. And I am unwilling, even if there is an exciting thing, I'm still unwilling to delve out because if something's work, I don't break it. I
right.
just don't.
No, 100%.
Right. So even though this has been on a 5-year trend downward, um, there is a fulcrum moment in here that's happening. This something at the company has changed.
Right.
So this is an opportunity for an individual stock to trade it, right? And you can see that in a 5-year condensed window, this has got a very steep inclination, which would, in and of itself, cause me some, as doing my type of investing and applying it, and that there's some form of somewhere, I don't know where, but somewhere in here, there could be some adjustment.
Right. Like I said, I think we've kind of
right.
come down out of the exuberance phase.
So then we go back out and look at that same program, and let's go back and see what happened. My little notation didn't work out at that scale very well, but essentially we're talking about right here. You can see it down below, right here, that the market and the people that know stuff. This is not you and me. We don't get to know stuff. That's why I like follow technical things, not so much story things. I'm
Right.
always at the tail of the story. It already happened before I get to understand what's going on. But you can see that there is a very major something and a bunch of money poured in here, a bunch. And you can see that bunch of money reflected into the price. And then from there, it didn't just come back down and break down and wander off again and decide. It has continued to be accumulated. So this stock is under accumulation and has been since January.
Yep.
Don't know the story behind it, but it certainly would have been an indicator to me right here. Actually, 1, 2, and 3. It's somewhere there is a breakout story here. I don't know what it is, but I could probably trade this if I wanted to. And I'd spend a little time figuring out how I might go about doing it. So, so kudos to you for identifying this breakout for your kind of trading. And the reason I wanted to use this is because I don't need everyone to know my type of trading, but yours too. I mean, you can't learn anything if you don't experiment with other things.
I basically have an account that's set aside that I have basically designated as gambling money, where it's money that I am willing to lose so that I can use it to learn how to trade better and how to, use the tools that are at my disposal, since nobody teaches this.
So let me share one thought with you.
Yeah.
Because I'm not a fan of a concept of money to lose. And I know that's not what you mean by it, but I am unwilling to lose any money. I don't put money anywhere using that logic.
Mm-hmm.
I put money. I think that the transformative linguistical expression should be that, it's not a linguistic expression. It's actually an attitude or an emotional situation. You've got to separate yourself from your money. You have to keep your brain and emotions out of the money. Money is only a thing. So it's a resource. So you have to plan your resources. I never plan on putting money in somewhere I'm willing to lose, because I always have a plan to win. And if I'm wrong, I may lose. But because I'm not emotionally connected to the money, the loss is not important to me.
Right. I think that's a good way of expressing what I'm talking about.
Yeah, I do too. I'm not a fan of the term. I wish it would go away. I have other people that tell me, well, I only put in what I wished I could, what I'm willing to lose. Okay, well, go stick it in the slot machine then. If you're willing to lose it, you might as well.
I think that's the wrong way of saying it. I think it's what you can survive losing, because you're making an investment. Investment is guaranteed.
Again,
when you're talking about this, I think a lot of people, especially like with the rise of Robinhood and then options trading, like people are doing stupid things with money.
Right.
Because they're like, oh, it's free money. They don't understand the risk there. And they put in money that they can't afford to lose, money that they are emotionally tied to, their well-being depends on, and
right.
That's when you really can run into some trouble.
Well, and I think that was the additional comment I wanted to add into what you were saying, was just simply that it's not money. Again, it's not money you can afford to lose. It's not money. First of all, nobody should put money into any kind of trading environment that they need, ever.
Exactly.
If you're 21 and you're planning for your future, and your future is not as a professional trader, and that you went out and gained experience and then learned how to manage your risk at all levels, then you should incrementally just be a steady buyer of something you believe in, whether it's an index or stock or 3 or 4 stocks. I would never spread my money over tons of stocks. That averaging down your yield is never a good plan, but
I mean,
you should
realistically,
always,
that's what buying an index is, but go on.
well, not really, because the old strategy is, I'm 66, so what should I have? Oh, I should have a mix of like 40% bonds, 20% of this, and some dividend stocks, and a little bit of equity. Okay, yeah, I'm old now. I need my money, and I know that you're trying to protect me by saying I need to have it more safer, but at the same time, I need more money. That's because I'm old and I'm retiring. So.
Right.
But I think it's a great opportunity, especially for youngsters like yourself, to find something, invest very long term um, in that something. But that's not what the show's about. This is about kicking the dirt up and finding out what's happening out there and trying to outthink everybody else at all times, right? Theoretically.
Or at least not lose your ass.
Yeah. So
that's probably where we should end the show for this week anyway.
Yeah, probably. Again, it's always fun to beat this stuff around, but I'll be here next week.
Same.
Probably. Well, I'm thinking I'll be here next week.
Well, I'll probably, we'll see, because it's supposed to go up to 115 here for 2 or 3 days in a row, so I might not be here next week. I might have just perished, in which case I give you full permission to carry on the show without me.
Without you, you make it fun and interesting. I am boring and snoring.
Well, see, you're the one who makes it at least marginally informative, and it's not just me talking out of my ass.
Oh, you're so nice. Anyway, buddy, good talking to you, and I don't know what came of any of this, but it was fun, and we'll talk next week.
Sounds good. Talk to you then.